Welcome to the Broken Pie Chart Podcast, episode 326. I'm your host, Derek Moore. What is going on with 30-year yields? Is it something to be concerned with? Seemed like it was a big deal in the financial media. If you look on Twitter, sky is falling. All right, what's going on here? And just to bring you up to speed here. So the 30-year Treasury closed the week 5.031%. The effective Fed funds rate is 4.33. And right now Fed funds is 4.25, 4.5. So we're kind of right in there. And you look at 3-month yield, 4.34, which is basically the effective Fed funds rate. So is this a big deal? And I would say at first, I want to give you a little perspective. Remember, the 30-year Treasury bond was only first issued, I think was it 76, 77? Probably 77, because the data I pulled down started in 77. And what I wanted to do was I wanted to look at the average spread between the 30-year Treasury bond and the Fed funds rate, meaning if Fed funds is 2 and 30-year Treasury is 5%, that spread would be 3 percentage points. Easy enough, right? So I pulled data and I looked at and I just did the monthly because the daily is pretty large. I think I used the average, not the end of a month. I think I used the average, so kind of average the dailies. I believe that's how I did it. And you look here and you say, all right, the average spread between the Fed funds rate and the 30-year Treasury is 1.52. So if you took the Fed funds rate plus 1.52, effective Fed funds is 4.33 plus 1.52. If you use the average, the 30-year Treasury bond should be 5.85%, not 5.031%. Okay. And people would say, well, wait a second. That includes crazy inflation and includes when, yields were, the 30-year yield in 1983, look in March right here. Yeah, March, 17.19%. Oh, actually, no, that's Fed funds. Fed funds was there. 30-year yield was 12.34. And of course, but we know that in 1982 that you could have bought, actually 82 is a better one. I mean, close to 14.22%, the average monthly in January of 82, which is kind of when rates crested for the most part on that one. So you say, well, it includes these crazy inflation years. So then I said, okay, well, what if we used the average since the end of 1982? And it's 1.84. And so if you use 1.84 and you eliminate, the crazy period of the late 70s, it's 1.84. 1.84 plus the current price of the Treasury, effective funds rate 4.33 plus 1.84. It says that the 30-year yield should be 6.17%. All right. And then some people say, well, wait a second. What about when you had negative interest rates? And what about just a normal rate period? And what's a normal rate period? I don't know. I totally arbitrary, I said, well, what if we only looked at the monthly average in the spread between 30-year Treasury and the Fed funds rate? When the Fed funds was somewhere between 2% and 4.33% where we were today. This is totally arbitrary. There's no reason I picked these numbers. It's just, and that spread is actually higher than the previous two, 1.94. So if you add 1.94 plus 4.33, you wind up with 6.27%, is where the 30-year Treasury bond should be if we were just simply using the average in that arbitrary period. The reason why I bring this up is that I think there's a lot of people who have never, I think I've said this before, my first year professionally in markets was 94. But I realized that, 2008, 2009, if you had somebody who was 10 in 2008, how old are they today? I mean, that's the thing. You start to look at that. If they were 10, they're 27 today. If they were 20 back in, or 20, let's say 22 back in 2008, they're 39 today. So think about someone who is, 39 or really under 40. And I think the memory is really that rates have always been low and it's just different. People are not used to seeing sort of like a 10-year treasury and a 30-year treasury, specifically the 10-year, kind of being around the long run average. So is this concerning that rates rose on the 30-year? I would say that if you're giving your money to somebody, in this case, the somebody is the US government, for the next 30 years, shouldn't you get more of a return than if you're giving your money to the US government for 3 months? And we know that yields have been inverted. They are uninverted, except when you look at the 2-year is just under 4%. The 3-year is 3.96. The 5-year, 4.078. And I would say, the 7-year, 4.21. Those are all lower. Those are inverted with Fed funds rate. Should those be higher? Maybe. So the point I'm trying to make is there should be a spread between the Fed funds rate and the 30-year. You should get more, even if we just use the 2-year, because the 2-year is a little bit more of a market based as opposed to the Fed funds, which is set by the Federal Reserve. I mean, if you're getting around 4% for giving your money for 2 years, shouldn't you expect to get more going out on the curve? And then, so why is it concerning or not concerning that rates are rising? Well, anytime you have an interest rate that rises quickly or unexpectedly, I mean, there can be ramifications. I would say that, a 5.031% US 30-year is not a crazy interest rate. It's just different than what everyone who's been in the markets for not as long as people like me or people are older than me have really seen. I mean, I remember getting 5% in my checking account in the 90s. Imagine that. Your paycheck comes in, you're getting 5%, and you just got that. You just got that in the money market. So look, a lot's going to be made about the treasury yields. And the other thing you'll probably see is so remember, banks can do what's called available for sale. Those are things that they mark to the market because they quote unquote are available to sell. And then they do this thing where they say, well, they'll be held to maturity. And held to maturity means the banks don't have to mark those to the market, meaning if there's losses, they don't necessarily have to, account for those losses. And I think the next thing is you're going to see some graphs that show, so the FDIC puts out I think it's quarterly, well, they'll put the balance sheet and the losses. But what does this mean for the market? Well, remember 2022, when rates went up, the market did not like that. Now, I would say starting in 21, 20, people still have mortgages that are in the 2 handles on 30-year mortgages, 2.875 or something like that. Interest rates were really low. And the sensitivity to a change in the price of a bond, meaning interest rates go up, bond prices go down, interest rates go down, bond prices go up. There's something called duration and there's convexity that gets involved. But what happens is when rates are really low, bonds market price is more sensitive to a change in rates. Today, when you have coupons 4 to 5%, bonds are less sensitive than they were in 2022. But certainly if rates were to go up, you look at TLT. TLT, I think, made a new, I don't know how many months or how many years low, but that chart doesn't look great because rates have gone up. Stuff on the far end of the curve, meaning things that have more time to maturity are more sensitive in general than things on the shorter end of the curve. So the other thing I would just point out is, and I always warn you about this, you look at the interest rate probabilities and how many cuts are factored in and all this. You remember it was in was it coming into 23, I think, or coming into 24? I forget which of the years. 7 cuts are going to happen, and then there wound up being like, 2? So right now, if you look at the Fed funds futures, which are traded futures contracts, when you look at the price of those, you take 100 minus the price of that contract for the particular month, and that's the implied Fed funds rate. So you look at this and you say there's virtually, there's like 5.6% chance of a cut at the June 18th meeting. July 30th meeting, only a 20.7%. This is today. Remember, these move around. So no cut there. 46% chance of a cut at the September meeting. And then you have the October. The October is where it's still carrying, and it's only a 51.6% probability of a cut, but it's pricing in a cut. And then it's, almost 2 cuts by the end of the year. I think I said a couple of weeks ago, there's a scenario where the Fed doesn't cut. And is that bad? If they don't have to cut, does that imply that things aren't bad enough that they need to cut? Remember, the Goldilocks scenario is rates stay constant and the economy is just fine. Is the economy going to go into a recession? I don't know. Remember, 29 out of 30 economists were wrong saying that there would be a recession in 23. They get this wrong all the time. I see probabilities and graphs about probabilities. There is, and I will tell you, there is a disconnect between what's called the actual measurable data. Some people call that hard. I guess it's hard data, meaning the numbers that are actually coming out. Unemployment. You're looking at job losses, just numbers of, corporate profits, all this stuff. And then there is sentiment. And sentiment is just what people think. It's not actual data. It's what they think. And sentiment is much worse than the actual data right now. Does that mean the actual data is going to not get worse? I don't know. I'll let you know when I know. But I would say that, and especially I think there's a lot of political bias that comes into this. We saw this during the last administration. It was sort of flipped. This administration, it's flipped the other way. And sentiment is sort of negative right now. People think inflation is going to go up. People think the economy is not doing well. But the numbers don't really match that. So this is something to watch. We don't necessarily want to see a really big spike in rates, but I'm just saying, like, if you look through historical stuff and past performance, there's no indication of future results, of course. We always say that. But you should get paid more for going out more on the curve. And there's two schools of thought now. One is that inflation's going to spike, and that's why the long end's going up. We don't really see it in the 2-year. I mean, sure, the 2 years, I think, up more than it was, but if inflation was really expected to spike, or the sentiment was that the Fed was going to start raising rates, wouldn't the 2-year be at 5%? The other is that the economy is, growing. I said, I got to think which episode this was, but I did a study and I looked at the 10-year yield, and then I looked at nominal GDP growth. And John Husband, who puts stuff out on Twitter, I remember reading, I think he had something out several years ago, and he showed the correlation, or basically look at the 10-year, and that's sort of where the market price is nominal growth. So that, kudos to Husband for doing that study. I wish I knew where that was. If I find it, I'll post it in the show notes. But what I'm saying is, if you look at nominal GDP, which is not adjusted for inflation, the long end of the curve, and especially the 10-year, 10, 20, 30, pick the one. It's sort of an estimate of what nominal GDP will be. So All right, enough about bonds. Let's talk about earnings. And we are at a forward 22 multiple in the S&P. And what does that mean? It means we're trading at 22 times the forward 12-month estimate at 263.81, according to Bloomberg. And that imputes about a 6.9% growth rate over the next 12 months. And then you look at, let's see, sales are expected to grow about 4% over the next 12 months. These are based upon analyst estimates. And by the way, sales, I know some people might say, well, 4%. I think the long run average is something like 3.5%. I'd have to double check that. And if you sort of look at this and you say, well, if the estimate is 263.81 for earnings per share on the S&P 500 and sales per share is 1958.80, that basically, if you divide the earnings per share into the sales per share estimates, it's about a 13.5% net profit margin. So the expectation for profit margins is still pretty robust. And a lot of people go and they say, well, the long run average and is much lower. And that's true. But I think profit margins have been steadily rising, decade to decade. Part of that is the types of businesses that are in the S&P right now are technology, higher profit margins. They're able to, if you look at Apple's net profit margins or Google's net profit margins or, some of these really big tech companies. I mean, look at Taiwan Semiconductor or look at NVidia and you look at their net profit margins. I mean, these companies have much higher margins than, say, a late 1970s, early 1980s that were more energy companies, businesses with big manufacturing, a lot of capital spending, capital intensive businesses. And look, I'm not saying that 22 times forward earnings isn't high. I mean, I certainly think it's on the higher end. Could it go higher? Sure. Could it go lower? Yeah, absolutely. Could earnings estimates be too low? They could be. So, you look at this and you just start to say, well, the forward is, we're trading at 22 times forward 12. We're trading at forward month 13 to 24, about 19.65. And month 36 through 48, in the future at 17.88. And, I always go through this, or when you look at where a market is and where it's from one point to another, the things that really are the attribution for returns include your sales growth, what the margins were on those sales, whether there's buybacks or net issuance. So a reduction in shares helps the EPS grow. You look at the dividend yield, and dividend yield right now is not that high, certainly on the S&P 500. And you look at multiple expansion or decline. And sometimes in a decade, we have multiple expansion. We have margin expansion. We have net share reduction. You also have new entrants coming into the S&P. Talked about it 2 weeks ago. DoorDash came in. Coinbase came in. Some other companies came out. So we're going to be, the big one coming up is NVidia. And we'll talk about their implied volatility and the type of move they're looking for there, at least in the options market. But you sort of look and you say, yeah, I mean, a lot of the earnings are out. NVIDIA is the big one. And then we get a respite from earnings for a bit. And then we do it all over again. And, what do we say? What January, February, March, April, May, June. Yeah. So then July will be the next earnings season. So we'll see. All right. We'll get to NVIDIA's implied volatility and the options ahead of earnings in a bit. Did see a few things that were interesting. Who had this chart? This was Goldman Sachs Investment Research. I don't know. Oh, Isabel Net put this on Twitter. And it was percentage of large cap mutual funds outperforming their benchmarks. And I think the reason why they put this on here, it's 50%. which is above the average since '07 of 37%. I think the reason, I forget the context of this chart, it's probably that active management is actually, it's a good environment for active management, meaning not just buying everything in proportion to a weighted index is kind of the point they're making. And I guess it'd be more helpful if they included not only mutual funds, because I got to be honest with you, I think a lot of people are going away from mutual funds and buying ETFs. So maybe this chart should have included ETFs. I don't know. The other thing, a couple things that we're seeing is we're starting to see the chart. So somebody had a chart. This is the 30-year Treasury yield hit the highest level since 2007. Yeah, I mean, I would just go back and say, I mean, rates were zero for a decade. Fed funds rate was a quarter, 0.25%. You had a 10-year that got under 1%. You had 30-year treasuries in, I think it was 2020, that were, I don't think it got below 1%, but I know it was below 1.5%. So, you start to see these, it's like, well, yeah, if you get into a normalized interest rate environment, Your Timmer at Fidelity had put out a chart and correlation to S&P 500 last 5 years. And the 60/40 portfolio had a correlation of plus 98%. So it was 98% correlated, if I'm reading this right. And I'm looking at his chart. And look, I mean, we've been saying for a while that I think there are just better alternatives to 60/40. This is one of the reasons why we buy the market, but we hedge. Remember, when you go to a 60/40 portfolio, you're essentially saying, instead of owning 100% equities, let's say, because 60 is equities or stocks and 40% is bonds. And a lot of people do this, 60% SPY, 40% AGG, for an example, if you're going to do this with ETFs. But if you want to drop down to 60, you essentially are selling your 40% of your portfolio to buy bonds. And the hope is that when you need bonds most, they will be non-correlated to equities, to stocks. And what Year Timmer is showing on this chart from Fidelity is that, I mean, basically 98% correlation, 60/40. So the 40 maybe didn't really help you. I know, here's the thing. This is only including the last 5 years. And we know that bonds got killed in 22 because interest rates shot up. And so not only did bonds decline, but stocks declined in sort of sympathy, I would say, and obviously when rates went up that much and we had inflation, you had issues there. And then you look at the MSCI ACWI, ACWI, is that the all world? Yep. So the all world was 96% correlation, meaning, and look, I mean, that's weighted towards the US. I mean, the US has a greater percent, as the biggest slice in that. But okay, that didn't really help you. And then you look at the MSCI ACWI ex-US, so the all world ex-US, 73%. And you might say, well, all right, that was good. Besides this year, over the last, prior to this year, if you go back 4 years or so, the US outperformed international. So my guess is that would have, that would have hindered your performance. Bloomberg High Yield Index, 70%, 72% correlation. No surprise there. Historically, I would say 65% correlation of high yield to equities. Now, high yield, the Bloomberg High Yield Index, I'm not, off the top of my head, I don't know the duration there, how long the maturities are. In some of our strategies, we like to use short duration high yield. And look, I mean, if you want to know about some of these strategies, you can always email me, derek.moore@zegainvestments.com. That's derek.moore @Z as in zebra, E as in Eddie, G as in George, A as in Apple. investments you got to spell correctly on your own. Otherwise, you can't email me.com. All right. Yeah, nothing else to do here. I would just say that there's correlation and there's also additive performance. And you could have something in your portfolio that's 100% non-correlated, but drags your portfolio down. You can have something that goes up when the equities are going down. But I thought it was an interesting chart when you think about the 60-40. Like I said, you have to sell 40% of your portfolio to buy the bonds. That's why we'd rather buy and hedge, where we're sort of taking a much smaller slice to hedge, but you own more of the stuff that, in theory, quote unquote, maybe you want to own. And also we find that even retirees or new retirees especially still need growth, especially retirees who are retiring earlier, which we are seeing. All right, we talked about 30-year bond. Eric Baltunas put something out on Twitter. TLT, which is the ETF that looks at, I think it's 25-year, 2025 or 25 to 30, I think around 25-year duration. So further out bonds. Took in nearly $1 billion 2 days in a row and is nursing a 15-day inflow despite screaming at everyone like a scary monster. Narrator, it was actually up yesterday and is up again today pre-market. Okay, this is from Eric Baltunas. That was yesterday. And I think the reason why he posted that is, remember, everyone was just saying, hey, rates are going higher. The 30-year TLT has been going down recently. And yet people are piling into it, seeing inflows. What's interesting, I mean, a lot of times when something is going down, you see outflows. So that was interesting. Speaking about valuation, and don't get me started on valuation, because sometimes I think, again, people go back to the long run averages and they're looking at times when there were paper companies and chemical companies and energy companies versus when you have tech companies. But the stock 600, which is a European index, congratulations. The valuation is at the long-term average, 12-month forward PE for the stocks, 600, 14.6. Apparently that is right about the long-run average. So, and I mean, besides in 21 where it was above, it's been below for, going back to 2020, except in 21, it was way above. There's nothing to do here. The source here looks like DataStream, Goldman Sachs Investment and Research. The dollar. So, yeah, when you look at when you look at the dollar, let's see what they're doing. This is a Bloomberg and macro bond chart via Isabel Net on Twitter. And they're saying dollar faces a secular decline. Now, I think what they're trying to say is they used, I don't know what they used here. Anyway, the dollar has been selling off. And what's interesting there is, in theory, it makes U.S. goods cheaper. It makes foreign goods more expensive. But it does help multinational companies because when they sell things, they get their revenue in the local currency, but then they have to report those earnings as dollars on their earnings reports. And so a strong dollar, that's when you see the big companies like Microsoft say, oh, our earnings would have been this, but for the strong dollar. Well, it's kind of reversed now. When you have a weak dollar, it actually helps earnings a little bit. All else equal, and it never is, you could have companies' earnings go down just because they're spending too much or they're not, or their revenues, but from a dollar contribution, that's actually helpful. And another chart, this is from Bloomberg. The dollar breaches a 4-year-old bullish trend channel. So if you can see this, it's oscillating up and down, going up and to the right, and it recently went below the trend line. So, yeah, we've seen the dollar sell off. Short interest is higher. We look at median short interest of the S&P stock. Short interest as a percent of market cap. So it's back to sort of the pre-2020 levels, and certainly not. I mean, this thing went up to 3.6% probably in 2009. It's 2.3 today. So I don't know. Short interest on the S&P has gone back to more of an average level, maybe, according to Goldman Sachs. Well, Goldman Sachs didn't say that. I'm just reading the chart. So, all right. So NVidia, I think their earnings are the 28th. What is that? Thursday, I believe. I'd have to double check that. But we want to take a look and we want to see. I didn't cover Japanese bond yields. Real quick, lots being made about Japan's JGB 10-year yield. And this is another one where, I mean, they've had really zero rates for a long time, and their rates are same thing. Their 10-year is back to 07 level. Same thing that you saw with the 30-year Treasury. So I mean, bond yields are sort of normalizing a little bit. So I don't want to get into this too much, but I think you should expect to start to, on YouTube or Twitter or elsewhere, people start to say this is going to be a big problem. I don't know if it is or not. But, Japan they had negative rates for a while. They had zero rates for a long time, very, very long time. So, bond yields are normalizing a little bit. All right, let's move on from this, though. I want to look at NVIDIA's options, and we kind of like to look at this. So if we look at the March 30th expiration, so that will be after earnings, but it's the nearest one to their earnings, and it has the implied volatility priced in there. If I look at, there's nothing just at the money, but let's use the 131 strike, closed Friday, 131.29. So it's a 100.54% moneyness. Moneyness just is a fancy way for saying it's 0.54% in the money there. If it's 80, it means it's 20% below the market. If it's a moneyness of 120, I mean, it's the strike that's 20% above the market. All right. Fancy way of saying it, but we call it moneyness. The implied volatility is about 87%. And if you look at 87% and you divide by 15.875, which is the square root of 252, which is the number of trading days in a typical year, 5.52% is the implied one-day move, up or down. 68% of the time, you'd say one standard deviation, 5.52%. For a single day, there's only 4 days next week because the Memorial Day holiday in the U.S. And you take the square root of 4, which is 2, times 5.52, and it implies a standard deviation, about an 11%, one standard deviation implied move. Could be up or down. Kind of that's within the range. And then if you price the straddle out, if you bought the call, bought the put, and you say, well, I don't know where it's going to go, but I think it's going to move. Basically, you have to move roughly 8% to make money. So, it's not, look, you obviously you see the implied volatility is elevated and versus other months. And, if you look at just the next month, and by the way, even though next month, it still has the earnings in there, but the implied volatility is 64.77. If you go out to, let's go out to October, kind of an arbitrary pick, but we look at that and there's not a 131, there's a 130, which is a little bit, it's right around 47, 48% implied volatility. So you'd say, it's kind of double due to earnings. And so basically, and this is my public service announcement. Everyone knows, I'm putting that in air quotes, that a stock could potentially move based upon an earnings report, up or down. And the options market knows that. And that means the premiums that one pays for options are higher because it's pricing in there'll be a move. And sometimes people say, well, this is easy, especially new options traders. I know it's going to move. I'll buy a call, I'll buy a put at the money. It's called a straddle. And that is a more complex trade than you think because it's really a volatility play. And you could be right, but you could lose money in this. And then you could say, well, I'll sell it then. You could, you could lose money because let's say you get a move outside of what's priced in, shorter call, shorter put. You've got unlimited loss on the call side. You've got loss all the way to zero, which would be 131 points. Do I think NVIDIA would go to zero on an earnings report? Probably not. But be careful with stuff like that. And there's better ways, I think, to do an earnings trade, or this, you can use spreads. If you own the stock, maybe you could sell some upside calls, or anyway. But try not to do the straddle. Everyone thinks it's an easy trade, but that's what the options market has. We'll see what NVIDIA's earnings are. And look, this is a really big company. And I think not only what their earnings report is, what their forward guidance is, and what their CEO, Jensen Huang, says about the future, about the orders that they're seeing, tariffs, all that stuff. It's going to be an important earnings. It's probably one of the more important ones that we see. So we'll see what happens. All right. This week on any recommendations, I'm trying to think if I have anything. I've just been watching hockey and feel bad for the Canadian listeners who lost both the Winnipeg Jets and the Toronto Maple Leafs. Those are out of the playoffs. And Toronto has got, I think it's 57 years since they won a Stanley Cup. And look, as a New York Rangers fan, Rangers didn't win it until 94. They last won it in 1940. So that was 54 years. So I'm familiar with what you're going through. But thankfully, the Rangers did win a cup. And if they never win another one, doesn't matter. I still saw them win. All right, that's all I have this week. We'll be back next week. Send me emails. I like getting emails. And remember to pass this on to a friend or even someone who's not a friend. Refer them to the podcast, give them the links. And if you have a moment and if you want to click the 5-star button, apparently that helps us. I don't know why it does or why it doesn't, but people tell me I should be asking the audience to do that. So there you go. And hey, if you're looking for a good book over the weekend, Broken Pie Chart, available on Amazon, and Jay's book, which is Buy and Hedge. And then my book, Effortless Public Speaking, is also on Amazon. That one's really cheap right now. I think it's less than $10. So if you're looking for a good Memorial Day weekend read, check those out. All right, we'll be back next week. Looking forward to talking about NVIDIA's earnings. See you, everyone.